It's pretty routine in the life cycle of any sort of tax advisor to run into situations where you participate in the bulk preparation of tax planning strategies, usually for a fee because you're not giving away your knowledge and advice and work for free. And there's a number of strategies that are tried and true, or at least appear to be so based on custom and history with the IRS. But there's some that push the boundaries, and those are the ones where you seem to really add value. But you have to be careful, because in some cases, liability can attach to the promotion of tax benefits, not with respect to the client, but with respect to the advisor who is organizing or selling a particular tax strategy. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. Today's episode 233, dives into promoter liability. This is on my radar because of a recent Chief Counsel memorandum, 2021-34016. And this memorandum brings up Code Section 6700, which is the code section that imposes liability on a promoter. Now, as always, this presentation is not intended to substitute for legal or tax advice. It is provided for educational purposes only. A little bit about me: I do what I do because I enjoy speaking and teaching. So, if you'd like an in-person or virtual speaker for your upcoming event, or for your firm or organization's in-house activities, you can email me at griffin.bridgers@gmail.com. And if you'd like to hear more from me and get access to more exclusive content outside of this channel, you can subscribe to my newsletter at griffinbridgers.substack.com. Now on to the presentation. Now, the subtext behind this is we're not going to get into tax shelters and what those are, because the IRS does have its own subcategory of tax shelters that it deems abusive and that are on naughty lists or top 10 lists every year. This presentation isn't about that. This is more about tax strategies in general, of any type, of any form. And the context is going to be Code Section 6700, which a lot of practitioners are unaware of. But it imposes liabilities on promoters of tax strategies. So who is a promoter? It's any person who, with respect to any sort of partnership or entity or investment or plan or arrangement, either organizes that tax strategy or assists with the organization of it, or participates directly or indirectly in the sale of that tax strategy and gets somebody else to organize it. So either role, organization or sale, can get you in trouble here. And if you're a promoter, the context of what we're looking at today is that liability can attach based on the statements that you make in the organization and sale process. So the standard here is where you as the promoter knows, or where you have reason to know, that the statement is false or fraudulent. So we'll get into that a little bit more. Now at the end, I'm also going to touch on the fact that promoter liability can step in when there's a gross valuation overstatement with respect to a deduction or credit. But that's not really the focus of today's discussion, because this recent Chief Counsel memorandum I referenced really dives into the analysis of what is a false or fraudulent statement. And it does a great job of summarizing some of the key cases that are out there that dive into this definition. Now, this memorandum, the Chief Counsel advice, was issued in the context of a promoter of micro-captive insurance, which has been a hot topic for a lot of planning in the IRS. But we're not talking about micro-captives today, and it's important to note that this memorandum didn't really expressly limit its application to that particular type of promoter or strategy. Instead, it's just expanding on what's the law out there on false or fraudulent statements. And I think the biggest takeaway, if you remember nothing else in this video today, is just how easy it is to run into issues because no ill intent is required. A lot of attorneys especially are accustomed to the false or fraudulent statement requiring some sort of bad faith or other intent to act poorly. But what we're going to see is that this is more of a mechanical analysis, even though it uses intent-based types of statements. So we're going to look at some various issues that break down what is laid out in this memorandum. First, we're going to look at delivery and theme. So false and fraudulent statements can be both written and oral. So you have to be careful with what you tell a client on the phone, because even though you might reduce it to writing after the fact and contradict what might have been bad advice or false or fraudulent advice given by phone, you still could run into trouble just by simply making the oral statement if it can be proven. Now, the statements that I'm referring to, whether they're in writing or oral, can relate to either the addressing of the tax benefits themselves and what those benefits are and whether they're available, and it can also relate to factual matters that are relevant to the availability of the tax benefits. So, the tax benefits include the allowability of any deduction or credit, the excludability of any income, or the way the statute words it is any other tax benefit. Now what we're going to see, and this isn't in the statute, but what's going to fill in, especially with the specter of capital gain reform, is the deferral of income tax, because that's going to become the hot topic. And while that's not directly addressed, I bring that up as a warning to also say that strategies relating to that could end up putting you in this realm of being a promoter. Now, the context of statements is important as well, because they can take the form of advice or recommendations or even representations as to what the tax benefits might be. What's especially concerning here is the fact that representations of special tax treatment can simply be false or fraudulent when the tax treatment does not comply with the law. And this is the point where basically intent goes out the window. So, as a promoter, you're charged with knowing the tax law here. And if the strategy just simply doesn't comply with tax law, then the representation of tax treatment can be false or fraudulent. So that's one thing to keep in mind. And I bring that up because there's so many little nuances and gray areas to the tax law where even if you comply with the letter of the law, the IRS has all sorts of outside angles of attack it can use. Things like the step transaction doctrine, economic substance, assignment of income. There's all sorts of little things like that, or even with related parties that give the IRS an out to say it doesn't matter that you followed the form of the law. We're really going to look into the substance of the transaction. Now, another point is that the assertions made in the form of advice, recommendations, or representations also have to be qualified. So in other words, you can't take universal application. You can't say every taxpayer who does this will get this benefit. You have to be able to dive into the facts and circumstances. And depending on how far you get, that may dive into the practice of law. So if you're not an attorney, that's another area where you can run into problems. And this is also going back to the fact that when we look at assertions being qualified, that relates back to the factual matters relevant to the availability of tax benefits and the statements relating thereto as to how you need to qualify things. Now, the promoter's knowledge can come into play because the clients have to be informed that at least on a threshold level, a transaction can subject them to IRS scrutiny. And a lot of people like to be loosey-goosey with this and just assume that anytime you're doing tax planning that it could be subject to IRS scrutiny. But a lot of people just simply don't. So this is a point that, it helps to get this in writing that any form of transaction in the planning context can subject a client to IRS scrutiny. But doing that can shield you from having a statement that rises to the level of false or fraudulent. Now, going beyond that, I mentioned I'm not going to get into the definition of a tax shelter, but what this memorandum says is for an arrangement that rises to the level of a tax shelter, the promoter has an additional duty to clearly and unambiguously inform the client of the risks. And that also doesn't just extend to the client, it can also include agents of the promoter. So if you have a sales staff, they all have to know the risk clearly and unambiguously. Same thing for current and prospective or future clients. Now, penalties we're going to gloss over real quick, but the base penalty is the lesser of $1,000 or 100% of the fee collected for promoting the strategy. And that's per act of organizing or per act of selling a tax strategy. Now, Note that this penalty has a qualifier. It changes. This doesn't apply actually for a false or fraudulent statement. Instead, this is the penalty that applies for a gross valuation overstatement, which is where there's no false or fraudulent statement, but there's more than 200% of the amount determined to be the final deduction or credit allowable is the amount that was actually claimed, unless you can show to the satisfaction of the IRS that it was reasonable or grounded in some sort of logical analysis as to how you arrived at that. Now, that penalty increases to just a flat 50% of the fee collected, regardless of amount, wherever a false or fraudulent statement is involved. So, for example, if you're an attorney promoting a tax strategy and you charge $5,000 for that strategy and you make a false or fraudulent statement, well, in that case, 50% of that $5,000 you collect, or $2,500, could be your penalty there payable to the IRS. Now, it's important overall, with all these guidelines, as our key takeaway, to remember that the theme is not intent, it's more mechanical. So it's always good practice for any tax strategy to look at a statement of risks and to even quantify those risks, which may or may not be a good idea depending on the situation, but maybe to have the client give informed consent, especially for something that may push the boundaries at the end of the day. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. As a reminder, I cannot give tax or legal advice in response to your questions. Now, as always, thank you for joining me for this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.